Hi there, if you are a hotel developer and you are looking to create a set of financial projections for a potential investor or lender in your hotel development, then you've come to the right place because we have built a financial projection template built specifically for hotel developers. And I'm going to walk you through how the template works, how to fill it out. But before I do that, just a little bit of background. My name is Adam Huxema. I'm the co-founder of Projection Hub, and we help founders create financial projections for potential investors and lenders. We have about 100 different industry-specific financial projection templates for all sorts of different industries. But today, specifically focus on our hotel developer template. I put a link in the description of the video below to the template so you can grab that and follow along as you create your own projections. And this is a pretty sophisticated template. I'm going to walk through it step by step, but as a thank you, if you are willing to stick around to the end of the video, we're going to give you access to a coupon code that you can use to get a discount on this particular template as our thank you for sticking around. So with that, why don't we go ahead and dive into how this works. Okay, so we are on the At a Glance tab here. This is kind of the end of the process. So once you've created all of your projections, filled out all of the assumptions, you're going to come to this At a Glance tab where you see some key charts and tables and some key ratios. We'll just kind of walk through some of the different deliverables here. So you'll also get a 10-year cash flow statement, projected cash flow statement, a 10-year balance sheet, a 10-year projected income statement, and then you're actually going to get the cash flow, income statement, and balance sheet all broken down by month for each of the 10 years. So if you need that monthly detail, you'll have that level of detail. The other thing I want to show you here at the beginning here is our distributions tab. So this is a way to kind of understand some basic investor return opportunities, investor distributions. So what it does is it pulls in kind of your cash flow projections here. It allows you to put an assumption about what percentage of the cash that you have are you going to keep as a reserve versus what percentage will be eligible for distributions to investors. So you can set those assumptions here for cash reserves, and then you can set sale assumptions. So let's say we're going to sell this property after 10 years of operations, and the model is going to look to see what's the operating income in the sale year, what's that net operating income look like, and then what's the desired cap rate, or what's the expected cap rate that you think you're going to be able to sell the property for. That will give you a gross sale proceeds, and then you'll pay off the outstanding debt at that time, which will give you net sale proceeds. So in this example, we've got net sale proceeds of 26 million with a total equity investment of 9.2 million. And so if all of that equity, or if that investor owned 100% of the business and got 100% of the distributions, which are shown here, then we can see what the internal rate of return would look like for that investor. So IRR 15.9%. You can also see what annual cash on cash returns would look like as well based on those assumptions. Okay, so we have a bit of work to do though in order to fill the model out to get it to this point. So I'm going to go back now to the input tabs and kind of walk you through how to fill this out. So the first thing you need to know is that any assumption or any field that's highlighted in blue is an assumption that you can change without breaking something in the model. So we've got a projection start month here, January 1st, and we can put in the different room types that we'll have. And so I do have the assumption here. So let's say you have, standard room, a double queen, a single king, a double king, and a suite, and then you can put in the number of units that you have. Now, let's say your hotel also has a restaurant and a spa, for example, and you are renting out those spaces to an operator, to a restaurant that's operating out of the hotel, right? So you just own the real estate, you're not operating the restaurant, you're renting that space out. So in that case, what you do is you put in the square footage of the restaurant and the spa, and we kind of need to get this into this average daily rate idea for the restaurant and spa, because that's what's going to make sense for us on the hotel side. So So for the standard room, we're saying, hey, the standard room is 300 square feet with an average daily rate of $150. And that would be, if you're at full capacity, right? So we're going to get to vacancy rates here in a minute. So average daily rate of 150 for the standard room. And so that's all going to make sense to you on the hotel side. It's just a little bit more complicated on the restaurant side. Essentially what you need to do is think about the square footage, come up with an average daily rate for that unit. And really what this is going to calculate here is your monthly revenue per unit. So you can play around with this assumption until you get the rent where you want it to be. So if you want to charge the restaurant $9,125 a month and it's 5,000 square feet, you got to put in, $300 for the daily rate will help you get to that monthly rent. Okay. You can also put in a completion month. So this is a new development, right? And so this is going to include the construction period. And so what we're showing here is that these units are going to be ready. They're going to be completed and ready to start renting out in month 17. Let's say that's when construction is completed. And then the first rental month is month 18 for the hotel rooms and month 21 for the restaurant and the spa. And then you can set an assumption here, months to rent all units. And so the idea here would just be that, let's say you open and maybe all your rooms aren't actually ready yet. Maybe the public doesn't need to know that, but maybe, you've got most of the rooms ready. And so you actually open it and it's going to take 2 months before all the rooms are actually available to rent. So that's the idea here. You can always just put 1 in for this assumption if you think, these rooms are going to be ready to rent right away. That's great. Okay, here we can put in assumptions about additional revenue per unit per month. So let's say you offer parking, and I put in a little equation up here. So let's say it's $25 a day for roughly 30 days a month. So maybe 7 per unit is kind of the potential revenue there for parking. And then on the room service side, maybe it's $20 times 15 days per month. So maybe you think, hey, we're not everyone's going to get room service, so we don't want to say the potential is to $20 of room service every single day. So you can put in assumptions there as well. Okay, now down here, we can set an annual price increase. So this assumption is going to increase the average daily rates. And then you can set vacancy rates. So this is vacancy rates for all room types. This includes if you put a restaurant or spa or any other type of space that you're leasing out other than rooms, you need to keep in mind that this vacancy rate is for kind of all square footage, all units. So just keep that in mind. So we've got that at a 35% and then going down to 30% by year 6 and kind of leveling out there. Here you can select a percentage of tenants or customers. Maybe we should call that customers that generate so percentage of customers that generate additional revenue. So this is just saying, yeah, 75% of our customers are going to pay for parking. 50% of our customers are going to pay for room service. So you can apply those percentages on a item by item basis. And then the rest of this is really just calculations. It's going to calculate, you'll see starting there in month 18, you'll see rent start to come into play. Okay, next we'll go to our input operating expenses tab. So you can set a number of different expense categories here, and then you can put the specific expenses here, and you'll just want to categorize them with this drop down. So you might have maintenance, interior maintenance and an exterior maintenance, and lawn care and landscaping. It's all in the maintenance category. So you'll select the maintenance category. You can select a cost driver. So this is pretty useful where you can say, okay, this expense is going to be an expense for the entire property. Like marketing is not marketing for this particular room. It's marketing for the whole hotel, right? And so we're going to spend, what we're showing here is starting in month 18, going through month 120 through the end of the model. We're going to spend $500 a month on marketing for the entire property. But you can have other expenses that maybe are more scale with square footage. So maintenance could be an idea. It could be maybe that makes sense as a per square foot expense. You might also think it makes more sense as a per unit. Maybe there's a maintenance cost per room or per unit per month that you can use. Cleaning here is a good example of a per unit cost. So what I did is I just took a $25 a day times roughly 30 days a month to come up with a $750 cleaning cost per month per unit. Is what's going to be applied here as the default. Of course, you're going to be able to put in your own assumptions here. You've got utilities on a per unit basis as well, and so on. You also have the ability to put in some expenses down here as a percentage of revenue. So let's just say, like, well, we know we're also going to have some costs for accounting and maybe running payroll and HR, and you don't know exactly what those are going to be. You want to lump them into, like, here's our general and admin expense bucket, and we can set that as a percentage of revenue. So you can set that to 7% of revenue or 5% of revenue, and it will scale as revenue scales. One more thing to mention here is that you can set a reserve for replacements. So you might want to set aside some cash because this is real estate, and someday you're going to need a new roof, someday you're going to need new paint, you're going to need new windows, those sorts of things. And so if you want to set aside, make sure you're setting aside cash for replacements, you can do that with this assumption here. On the salary and wages tab, you have the ability to put in salaried positions. So let's say we've got a facilities manager, maybe maintenance staff, hotel manager, front desk staff. So I'll mention on the front desk staff as a good example here. You can say, okay, they're starting in month 18 in the model, and there's actually going to be 4 of this particular type of employee. So there'll be 4 front desk staff at this annual salary with this expected annual raise. Okay. So there is now an input financing tab and an input construction budget tab. I'm going to actually start with the construction budget. These two tabs are going to play kind of back and forth with each other. So what you can do here is you can enter in your different kind of budget for construction. And you can enter in these costs as a per unit amount and then apply the number of units that this is going to be related to. So for example, here I said it's a $275,000 cost per unit, and we're going to apply it to all 102 units. So you can see how many units you have right here. And again, that is ultimately coming from the number of units you put in here on the input revenue tab. So we're saying this cost is going to be applied $275,000 per unit for a total cost of $28 million. Now you can set when that money is going to be spent. And so we can say we're going to start spending that money in month 6 and end in month 12 of the model. And the model will just evenly spend that $28 million over that month 6 to month 12. You also can put in land development. And here's an example where you're not going to have a land cost on a per unit basis. You're going to have kind of a total cost. So this is a per property amount. So $2 million for the land development. And then you might have some situations where you have a bit of both. So let's say it's $1,000 per unit for painting for all 102 units, but also just $50,000 in a per property amount because you got to paint the lobby and you got to paint the exterior, for example. And that's not tied to a particular unit. So you can enter in those costs that way. So once you get all of that in, you're going to have a total development cost here. You can see a cost per unit and a cost per square foot. Okay, so we've set what we hope our construction budget's going to be. And now we need to go back to the financing tab and see if we can actually make this project work. Can we make it pencil? Can we actually afford that construction budget? And so the way that we do this is we start by saying, what is the desired or required debt service coverage ratio that your lender is likely to require? And so let's say your lender says, we require a debt service coverage ratio of 1.25. And so what that means is that you need to have $1.25 of net operating income, or essentially profit or cash flow, for every dollar worth of debt service, your principal and interest payments, in order for them to approve the loan. So they want you to have projected net operating income of $1.25 for every dollar of debt service. So what we do is, once we've created these projections, the model is going to tell us, okay, once the property is stabilized, once it's built and fully kind of operating, it'll then check to see, okay, what's your monthly net operating income? And so right now it's projected to be $209,000, roughly $210,000 here in net operating income, which means in order to keep a 1.25 debt service coverage ratio, you can afford a maximum monthly loan payment of $167,000 here. And that, then we can set assumptions about our interest rate and our term on the loan. So if we expect to be able to get a 5.75 interest rate over a 30-year term with a $167,000 monthly payment, the model is able to tell us, okay, you're going to be able to borrow, based on all those assumptions, $28 million, $28,785 there. And then we can set an assumption about what we want our debt to equity ratio to be. So if we say 3-to-1, so $3 of debt for every dollar of equity, then it tells us what our target equity amount is, $9.5 million, for a total kind of maximum debt and equity financing here of $38 million. Okay, so then the rest of this is gonna pull in what our construction budget is. It's going to pull in financing costs. It's going to tell us how much working capital will be available and how much it thinks is needed. And so right now it's saying, hey, you don't have enough working capital. Now you might say, well, the model thinks I need 1.6 million. I'm actually okay with living with 940,000. Or you might go back and say, okay, we need to have a 1.6 million of working capital, so we've got to cut some expenses somewhere in the construction budget, right? Okay, so then here you're going to enter in your equity sources. So let's say maybe you bought the plot of land and you put in $200,000 for the land already, and so that was already invested in month 0. And then you're going to raise an additional equity investment of $9 million coming in month 4. And then you're able to put in your construction debt right here in this box. So you put in your construction debt or construction loan with your expected interest rate for the construction loan only, and then whether you're going to pay interest payments on that and what month the interest payments will start. Now this box up here is going to assume that, hey, you're going to have, these are some big loans, and you're going to have loan financing costs, closing costs, inspections for kind of each time you take out a loan. So for the construction debt piece, you're going to have closing costs, and then this may not be relevant. You may not have kind of mini permanent debt, but in some cases, particularly in like multifamily, you might have construction debt, then you might refinance to mini permanent debt for some period of time, and then you might refinance again to something more permanent, a permanent debt. And so you might end up with kind of three loans in that process. So if you do, you can put in those financing costs and tie them to each particular loan here and the amounts. So that ties down to this refinancing section. So what the refinancing section is going to do, you can put in the name, the mini permanent debt or permanent debt, what month you expect to refinance. This will tell you what the debt balance will be at that refinance point, and then how much new debt you can put in, how much new debt you're going to take out. So let's say you want to take out more than 28 million because you want to also finance some of the closing costs. And then you've got 6.25% interest rate over 360 months. And then maybe after another 30 months, you're able to refinance again at even a lower rate at 5.75. So perhaps you do that again. So that's kind of the idea on the financing here. And so ultimately what you're going to want to do is, once you get this filled out, to really see, does this work? You want to come to your cash flow statement. And I would look at your monthly cash flow statement. And so what we see here is we are seeing like a negative cash balance. A bit of that could just be timing. You know, like in the model, you're starting to spend on capital expenditures right in month 1, but we're saying that the equity, 9 million equity, didn't come in until month 4. So you might want to look at that and say, no, we really need the equity to come in, be in the bank account in month 1 in order to cover those first few months. And then basically the model is going to draw on the loan. It's going to use your equity first, and then it's going to start drawing on the loan. And then once you are operating, what you're going to want to see, you can see here revenue starts to come in, but look, we're negative. We have a negative cash balance. So that's why the model in the financing tab here was saying, oh, you don't have enough working capital. You don't have enough working capital. It thinks you need 1.6. You only have 940. And now we can see why that's a problem, because we're about 600,000 short here. So that's why it wanted you to have some more working capital. So you might raise more debt, you might raise more equity, you might cut your construction cost by 600,000 or something to have sufficient working capital there. But that's what you're going to want to look at, and ultimately make sure that your cash balance is not negative at any point. So that is really the basis of this model. There's a lot here, I know. It's kind of complicated and sometimes difficult to get the project to pencil out. And so if you have questions, feel free to reach out, tell me about your situation. I can try to help you with that. You can email us at support@projectionhub.com to get any help. And then also, just as I had mentioned at the beginning of the video, as a thank you for sticking around to the very end here, wanted to give you access to a coupon code. So if you go to the description of the video below, you're going to find a link to a form to fill out to get that coupon code. So when you fill that form out, it's going to give you access to our most up-to-date coupon code, so you can make sure you get one that actually works, and then use that at checkout as our thank you for sticking around to the end. Again, if you have any questions at all, please don't hesitate to reach out at support@projectionhub.com. Thanks.